how do we invest your money? We don't pick individual stocks and try to tell you that we're going to have huge returns beating the market every single year. Instead, we use a disciplined strategy based on 100 years plus of stock market data. We look at what history and the white paper research tells us is the best way to preserve and grow your wealth. This strategy is built around low cost ETFs and mutual funds that spread your money across thousands of different companies in the US, internationally, some large companies, some small companies, value companies, and growth companies. We're making sure that we aren't trying to time and beat the market, but we're doing what research and data tells us is the best way to preserve and grow your wealth. This strategy is based on decades of research showing that broad participation in the entire market, and then also tailoring that strategy to your specific situation and your tolerance for the ups and downs of the market is all in line. It's what wins in the long run. We will run into down years in the market. That's unavoidable. The goal here is to take the right amount of risk that you're comfortable with, but taking that calculated risk where we get paid off for higher returns in the areas where we do want to invest and grow the money. We want to be there for you during the ups and the downs to make sure that we're not making any rash emotional decisions, and looking at what history and data tells us is the best way to be preserving and growing your money. For someone going into retirement, or if you're already retired, the broad strategy really comes down to how much money do you need to be taking out of your overall investment portfolio each year. Once we get that number of how much you're going to be taking out each year, then we want to build up 3 to 5 years worth of those annual withdrawals from your accounts and have a good conservative base there, kind of like our rock to hold us steady, so that if we do have a downturn in the market, which can last 3 to 5 years, that we've got a good base there that's going to be holding steady and not being subject to the ups and downs of the market. And we could live off of that for 3 to 5 years, while the money that's invested for growth in the market, although it may be way down, we've got that steady rock there to hold us and help us make it through that downtime, while the rest is positioned and off to the races. For example, say your annual expenses are around $200,000 per year. Then let's say that your Social Security and your pension are going to cover about $100,000 of that. So that means that we're going to need to pull about $100,000 per year from your investment accounts to live off of. So what we want to do is not just pick some allocation of, like, say 60%, 40% stocks and bonds and just set it like that because you're already in retirement. We want to take that $100,000 per year that you need to take out from your portfolio each year, and now put aside about 3 to 5 years worth of that. So let's call it 4 years, say $400,000. So we're going to have about $400,000 of that money in conservative, short-term, low-risk government bonds. That stuff is going to be holding steady, and it's going to be our rock. It's not going to be giving us the greatest possible returns, but it's going to stay there even when we have downtimes in the market. After we put that $400,000 into that more conservative investment allocation, the rest of the money, however much it may be, say it's $4 million more, we want all of that to be set up for long-term growth so that it's outpacing inflation and healthcare. We don't want to be leaving dollars on the table and missing out on what drives real growth, which is diversifying your money over US and international stock markets. So we can't just say, you're 65 years old, therefore you need to have a 70-30 or 60-40 stock and bond allocation. No, we want to look at what you actually need to be taking out and use that to drive our investment allocation decision.